For the next portion of this course, let's cover risk management. Trading is very fluid. It's an art, and there's ebbs and flows. You'll go on win streaks, you'll go on loss streaks. Sometimes your strategy is killing it, and it's the perfect market environment. And sometimes you're going to be struggling, and you're going to be fighting to survive. It happens even to the best traders. There'll be times where you're just trying to stay above water, just make it through this period of weakness for your strategy and get out on the other side. Knowing when to lay on the gas and when to lay off the gas is a skill that's really only built off experience. And that can kind of suck to hear when you're starting out. Like, oh, you're going to need a few years of doing this to really build up that skill. Now, what could be consistent and should be consistent, and what you should work on above all else when you're starting, is your risk management. The way you manage your trades and your positioning should never change from day 1 to day 9,000. Risk management is math, all right? Trading is an art, but managing risk is not. Okay, you should manage your risk like a robot. And there's several different ways to do that, depending on what you can tolerate. Some people, they only trade with a small portion of their total account. They trade with 1% of their total account, and so they're willing to go wild. They're willing to just straight gamble on wild probabilities. If it hits, it hits. If it doesn't, they don't care. They're fine setting the money on fire. As a trader, I want to not do a lot of that, right? I want consistency and want probabilities to play in my favor. My goal is to get rich over 100 trades, not one trade, right? Developing that consistency is most easily done through allocation that you put into a trade, right? So when I set up a trade, typically what I'll have is my strike, my stops, and the key levels I'm looking for. And then I'll rate the trade as well. So when I'm managing the risk of this trade, I'll think, okay, if I actually hit my stop, how much do I lose on this trade? What is the value lost here? Depending on what that value lost is, will then dictate how much I put into the trade based on my stop. And remember, my stops are set off the stock chart, not off the options. So I'm looking for key levels on the stock chart, not off of price of the options, right? So if I'm trading something that's on a very illiquid chain, it might have really wild swings. And therefore, it's going to be more essential that I'm looking at the stock chart and not the option chain. Especially on illiquid chains, you have different algorithms or even market makers playing with the contracts, trying to burn you out of the position. All right, they can see that you're just a small retail trader, and there'll be some algorithm trying to clean you up on those, trying to manipulate the chain. It's important to not get burned on that. Now, if you're on very liquid stocks, that's very unlikely to happen. And there are different ways that you can automatically figure out what that loss would be based on the stop that you have, which will help you better understand how much to actually allocate into the trade, right? So let's kind of cover how to do that within Thinkorswim. So as you can see, I'm in Thinkorswim right here. We'll go ahead and expand this so it's easier to view. Apple currently trades at 221.69. Let's say that I'm eyeing to buy some 225 calls if Apple gets over 222. We can see that these trade for about $254. You can probably get filled here at about 248. So let's say my stop is going to be 220. And I analyze the stock and I give it a C rating. Later in this course, we'll go over how I decide how to set those ratings. And let's say for C ratings, I'm willing to take a $500 loss. Okay. So given what my stop is, how do I know how much to allocate in the trade so that if it doesn't work out, I take a $500 loss, right? So we can actually automate this process if we go to the Analyze tab right here, right next to the Trade tab. And we click on the 225 strike right there. Okay, and we can see that's populated down below here, the 225 call. And then we go to our risk profile. We can see right here, that red line shows us where the contract is. If it was worth at the current stock price. And then we can simply drag this down to the 220 strike down here below. So if we go down to the 220 right there, we can see we're going to take about a $67 loss per contract. So if I did the math there, I could buy about, 8 contracts, and that would set it so that I lose $500 if the play does not work. And this is a great way to manage your risk with the allocation of the funds that you put in, saying for this rating of the setup, I'm willing to take this amount of loss. And then even for where this is, you can then automate the stop and sink or swim if you choose so, based off the loss and value of the contract. So I could do the math and I can say, okay, if I bought it for $254, that means the stop I would set for this would be after at around like what would that be? 188 is when I would stop. So if the contract reaches 188, I can just set it to auto stop. Now, a very important note to add is, especially on more illiquid stocks that don't have large trading volume, I do not automate my stops. This is because oftentimes my stop is a key level in the market, and the market loves to hunt out key levels. And it will stop out your trade and then often reverse at that key level. Discernment is 90% of the time going to be better than an automated stop. Now, there are some techniques you can use to help develop your risk management using automated stops, whether that be you set it below the key level and you kind of have some practice in doing that. Maybe that works best for you because you're someone who often likes to buy your losers rather than buying into your winners. It's very hard to get used to playing into the winner rather than playing into the loser. That's often a sign that you're treating your trade like an investment, which you should not be doing. But the one thing here that you can also do for risk management, so if we're going to close the position, by the way, we right click here, we would click close order, and you could go down here, you could set the stop limit, and then we have trail stops. Trail stops can be really useful for making sure that you get into the habit of taking profits. Okay, part of risk management is always taking profits when you have them. So you see, I can set this to 20%. So if this goes up 20%, I can have this position automatically sell, a portion of my contracts, right? If I have 10 contracts here, I can have it sell 2 of the contracts. I can have it sell 4 of the contracts. Typically what I'm doing at 20 to 25 to 30%, I'm taking off a fourth of the position very early on, always taking those profits. What that does is it's de-risking the position, right? The position originally started at 5,000, but now it's grown by 20%, so now it's 6,000. Okay, now I have more risk in the trade because I have more money into the trade. So I de-risk that position by taking some of those profits. Now, the last tidbit I want to add about risk management is called rolling your positions. And you should get into the habit of this when something's really trendy. If you bought SPY calls here at the open and you have the $75 calls, it goes to the $75 strike. You could take half of them off and let the rest run, or you can close the position entirely because on a move like that, you're likely up 120%. You can move that position entirely. So you can say, okay, I'm in the 575s. They're now worth $396, right? So now I can switch to the 580s and I can buy, let's say I had 10 contracts here, I could buy 4 contracts here at the 580s, and the position is pretty much free, right? Because I'm just playing with profits. In fact, you might, if you only had 10 contracts here, you might even only buy 2 contracts here and just use a portion of your profits and just roll the position to keep exposure to the move. Because if looking at a chart like this is very trendy. We'll go over charting and everything later, and then roll that position. You're controlling your allocation into it. You're keeping it into play. You're only playing with a portion of your profits, continuing to manage your risk, but not losing exposure to the play. Do not be afraid to reset positions when it's trendy. Play the trend until it breaks and constantly be taking profits along the way. The setup that you have, if you're using setup appropriately, is the best entry. But keeping with the trend until it breaks is a great way to maximize the profits that you can get out of your play. Knowing when to lay on the gas and try to maximize profits when the market is good and when it's trendy is going to be really key, because there'll be some times where there will only be 3 good trades a week. And there'll be other times where there's 15, 20, 25, 30 good trades in a week. The market's very trendy. It's moving very well. And it's those moments where you want to maximize your profits. Okay. That is so key to being a profitable trader, is using these strategies, consistently taking in profits, controlling your allocation, managing that risk, using appropriate stops, and all of that will lead to your success. Okay? We play into the winners. At the end of the day, this is so key. Write this down if you're taking notes. The market makes you money, right? You don't make money. Okay? This is great for controlling your mental. Do not get into the mindset of, oh, I'm a genius, I pick such great trades. The market makes you the money. Your job as a trader is to be a professional cutter. Okay? This isn't working. I cut that. I cut this. Okay, this is working. I got to cut this. I got to cut this. And you just set up the positions. You let the probabilities over time play in your favor. And your job is just to cut stuff and let the market make you money. Let the market do its thing. Either cut the losers, slowly take profits on the winners, and just let it roll. Play into the trends. Play into the waves. Okay, don't sculpt your opinion on the market. And it'll be such a huge key to your success. Now, the last part of risk management is going to be sizing trades. Now, keep in mind that a lot of this is also going to be personal. Some people have higher risk tolerances than others. You don't want to take a position that's so large that you can't sleep at night, that declines your mental health. That is going to be too taxing for you, okay? And over time, you'll learn how to take larger trades. You'll develop methodologies for that. Some traders, when their account even gets too large, they have to take money out. And there's traders in the Discord even that work with me that have 7 or 8 accounts because they don't like their account being too large, because it starts to mess with their mental. Over time, you're going to develop whatever process that works for you, that helps you control that helps you stay zoned in the zone, helps you stay logical. But when it comes to sizing my trades, I use a rating system, and I keep it very simple. There's no need to make this complex. An A trade has 3 points, B trade has 2 points, and a C trade has 1 point. Point system is a key level been broken? Is there a catalyst? And is there market alignment? Market alignment is very simple. Is the index that my stock is a participant in also moving with the stock? All right. Or is the SPY index bullish while Apple is bearish? Okay, we don't get a point there because they're not in alignment. Okay, and that's because the market, that's all about market breadth. Okay, 3 points means I'm going to put the max I'm willing to risk. Okay, the amount I can put into a trade and still sleep at night. 2 trades or 1 point, a C trade, is going to be the least amount I'm willing to risk. The alignment here shows the strength of the trade. If I do not have any of these working for a trade and I'm still tempted to take it, then it's going to be called a lotto, right?